In today's video, we're going to take a look at a company called Enbridge, ticker symbol ENB. This is the 13th video that's a part of my portfolio series where I'm doing an in-depth analysis on all 31 stocks currently in my own portfolio. If you're new to my channel, my primary focus is on income investing and also dividend growth investing with holdings that offer at least a 4% yield. As I'll say in every video in this series, this isn't done in any particular order. So just because this video is 13th in this series does not mean that this is my 13th favorite stock or my 13th largest holding. Also note that because I own all these holdings, I am biased towards them, so do your own research before making any investment decision for yourself. Also, feel free to let me know if there's any improvements to this series that I can make going forward. Feel free to check out last week's video, which was on the PIMCO Corporate and Income Opportunity Fund, ticker symbol PTY, which is a 10% monthly dividend-paying fund that's been a solid source of income for more than 2 decades. Going into my Vanguard account, which is where I do all my dividend investing, as of the making of this video, I currently own 48.416 shares of ENB. Enbridge is also my newest holding in my portfolio, which I added a couple months ago. Their stock pays quarterly dividends, with their last being for 65.78 cents per share. With the number of shares that I own of this stock, I receive roughly $31.85 every quarter, or divided by 3 is about $10.61 per month from this stock. Not a lot, but it's still one of my smallest holdings because it is the newest stock in my portfolio. Enbridge is a Canadian energy infrastructure company that operates through 4 core businesses, which are liquids pipelines, natural gas pipelines, gas utilities and storage, and renewable energy. The company transports roughly 30% of the crude oil produced in North America and about 65% of US-bound Canadian oil production. They also transport about 20% of all natural gas consumed in the United States through a midstream network that stretches for more than 73,000 miles across North America and the Gulf of Mexico. The renewables business generates enough green energy to meet the electricity needs of about 966,000 homes through their network of wind turbines and solar panels. The company was founded back in 1949 and they're based out of Calgary. Right now, Enbridge is currently my favorite energy company in the sector. They have a long history of solid performance and they have some good growth prospects going forward. Not to mention that energy stocks can make for good investments to own if you're worried about a recession. They're more defensive in nature and they have steadier revenue and cash flow streams under a wider range of economic environments. The company touts having a lower risk business model as highlighted in their investor presentation. You can see Enbridge was able to successfully grow their business despite the 2008 financial crisis, the commodity market collapse of 2015, the Fort McMurray wildfires in 2016, and the COVID pandemic. As we're about to see, this company continues to post some really solid results across its core businesses. So with that being said, let's go ahead and take a deep look into Enbridge and see how this company's been able to set themselves apart from other energy companies in this sector. Looking at their latest quarterly financial results, we can see that their revenue is broken down by each of their core businesses and how they've changed from a year ago. Their 3 largest businesses all saw revenue growth. Their energy services business did report losses, but a lot less from this time a year ago. Ultimately, you can see that their adjusted EBITDA and their distributable cash flow grew by 7.7% and 3.5% respectively. If we go back further, we can see consistent growth for Enbridge over the last decade. Starting with EBITDA over the last 10 years, you can see it's grown from $3.06 billion to $12.1 billion in 2022. That comes out to a compound annual growth rate of 14.7%. EBITDA stands for earnings before interest, taxes, and amortization, which is one of the most popular lines to look at in an income statement. The reason for that is because interest rates and taxes can change depending on policies over time, so not factoring those things in gives us a clearer picture as to how a business is doing over the long term. Enbridge recently had their Investors Day back in March and they discussed a lot about their company's expansion. The company's targeting an average annual growth rate of 5% going into the future through all their core businesses. According to the International Energy Agency, the demand for all forms of energy is expected to continue to rise for decades to come, and Enbridge is involved in all of these energy types. Despite what some politicians will try to get you to believe, Enbridge's products are not going away anytime soon, and in fact are expected to see a strong demand for them even 12 years from now. But the company has done a really good job in transforming its business by increasing their green energy output and by merging with other companies to expand their portfolio. In 2017, Enbridge merged with a company called Spectra Energy for $28 billion, which increased the amount of gas this company has access to. What I think is one of their more exciting expansions right now is their European offshore wind development. This global expansion I think is really going to help this company in generating new revenue sources, considering how there's a much bigger push for green energy in Europe compared to here in the States. By the year 2050, they're expecting their offshore wind capacity to grow pretty significantly, as you can see by this graph. When it comes to dividends, ENB in my opinion is one of the best dividend stocks in the energy sector. They currently offer a dividend yield of 7.05%, which is much higher than a lot of their peers. And at the same time, Enbridge has grown their dividend for more than 28 years and counting. According to their website, the dividends paid by this stock are classified as qualified distributions compared to dividends by other higher-yielding companies like BDCs and closed-end funds. Additionally, Enbridge is not a master limited partnership, and therefore they do not issue a K-1 tax form. If we look at their 1-year performance of their stock, we can see that it's currently down over 10% from a year ago. This was caused by oil prices suddenly falling, and I think it's completely unjustified. Remember, even with oil prices falling, Enbridge is still reporting record-breaking revenue. Despite being a conservative company, there's still risk involved with any investment. Considering Enbridge engages in the fossil fuels business, it does make them more susceptible to political and regulatory risk. Just a few days ago, Enbridge was ordered to cease operations on a section of a pipeline they own going through Michigan. A judge ruled that the pipeline must cease by 2026 when Enbridge is expected to have a reroute for it completed, which is due to the pipeline being partially located on an Indian reservation. These types of cases, along with a worldwide push for green energy, are some of the biggest risks involved, not just for Enbridge, but for all companies in the energy sector. As I like to remind people though, even with green energy being pushed really hard, fossil fuels are so prevalent in our everyday life that we can't just have them go away and be replaced anytime soon. They're in so many products that we're not going to see oil replaced in the foreseeable future. Here's a graph that I like to bring up every now and then that shows how significant of a role fossil fuels have in our lives. We're currently nowhere close to having a green alternative available for all of these different things. One more thing I'll touch on is this company's dividend payout ratio. If you check financial websites like Seeking Alpha or MarketBeat, it'll show you that ENB has a really high payout ratio that exceeds 100%, which looks terrifying. A payout ratio that's greater than 100% means that a company is paying a dividend that's so high that it can't sustain it if it remains over 100%. I get comments all the time from people saying things like, hey, this business development company has a payout ratio of 150%, or this master limited partnership's payout ratio is way too high. And what investors need to know is that when it comes to calculating a stock's payout ratio, you don't use the same metrics for every kind of company that exists. For most stocks, and nearly all financial websites report it this way, you calculate the payout ratio by dividing the total dividends paid by the company's earnings per share. But with many companies, you don't use EPS to calculate an accurate payout ratio. This is especially true for alternative investments like BDCs and companies like Enbridge because they report different financial metrics. With business development companies, for example, you look at net interest income per share when calculating a payout ratio. With Enbridge, they use their own distributable cash flow, or DCF, to show how much wiggle room they have in their distributions. If we go back to their first quarter financial results, we can see the company reported distributable cash flow of $1.57 per share. But that same quarter, Enbridge announced a quarterly dividend of about 66 cents per share. So if they're earning $1.57 per share in DCF, that's nowhere near exceeding a 100% payout ratio, and it's actually very comfortable for them. In summary, based upon what we've looked at so far, I think Enbridge is one of the best energy stocks in the sector. Although it's not a fast grower by any means, it's a stock that's still very solid. If you're an income investor or just love a high-yielding dividend stock, then Enbridge is a great candidate in my opinion. Energy is a sector that can be cyclical, but for this company in particular, I think it's a lot sturdier than others in their field. But with that being said, that's going to wrap up today's look at Enbridge. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis that I do in this series. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.